Hello everyone, and welcome to Alternative Design's presentation of the hidden power of defensive allocation. I'm Tim Harding, Chief Marketing Officer for Alternative Design, and I thank you for taking the time to join us today. Today we're going to be talking about, which is basically a variation on a theme, but the real message here is really pretty simple. It's why not losing money with your investments is really more important than how much your return is. Now, as always, if you have questions during the course of the presentation, please feel free to, at any time, go ahead and type them into the chat box on your control panel. I will be more than happy to respond to all questions at the end of today's webinar. So please don't hesitate. Ask anything that pops into your head. I'll be happy to respond to it. Just a quick reminder here at the beginning in case you need to get off early, and you'll have the same reminder at the end of the webinar, but we are coming up on the cutoff dates for the offerings for the month of August. The first cutoff is going to be Friday. That will cut off the Bank of the West Commodities Income Advantage product, so it won't be available for this month after 10 a.m. Pacific time, 1 p.m. Eastern time on this coming Friday. Everything else is going to close out on Monday, the 25th. So really, that's not much of an extension. So you do have some time to get those last-minute cases in, and as always, Chris Gross is here trying to make sure everything gets processed so that you get paid in a timely manner. We want to make sure the business goes in the month of August, and it doesn't have to carry over into September, which is fast arriving. I know a lot of families, their kids are going back to school this week. Different parts of the country start at different times, but summer is winding down. We're coming up on Labor Day, and it's about time to kick it into high gear. So you might as well get a good start here at the end of August and power your way into September, October, and November, where we really make hay. Those are the big months in our industry. So let's talk about the hidden power of defensive allocation. You know, investors tend to panic when the market goes down, and it always does. I mean, the market always goes up and it always goes down. It's just the nature of the beast. And we know that the typical consumer chases returns. They watch the market go up, and they wait and they wait and they wait, and they finally decide, well, it's going to go up forever, and they jump on board. And then, of course, what happens is it's too late. They're chasing returns. And they get caught in that bad situation where it's time for the market to correct. And the market always corrects. We just don't know when, but it always corrects. And so that happens, and all of a sudden, the consumer finds themselves with a loss. And so what do? Well, the typical reaction is emotional, and they get out. And we all know the story. What they've really done here is the exact opposite of what savvy investors do, and that is, instead of buying low and selling high, they did the complete opposite. They bought high, chasing those returns, and then sold low. And it happens over and over and over again, and there are hundreds of studies that demonstrate this. The average consumer, the average investor, seldom gets a full market return. And the reason for this, most people who are on the security side of the equation will tell you, is because they did exactly that. They panicked when the market turned down, they captured losses, and they weren't there when the market bounced back. I mean, that's the mantra, isn't it? Stay the course. The market always comes back. It always comes back. Well, yes, it does. It always comes back. It's just a question of how long is it going to be before the market comes back, and what is the impact of that time period going to be on the plans of that consumer. So, yeah, the market always comes back, and you want to be fully invested in the market at all times because you want to be able to capitalize on the best days of the market. And you don't know when those are going to come, just like you don't know when the worst days are going to come. So if you panicked and got out of the market because it dropped and then the market rebounds, you're likely missing those days. And so this slide, many of you have probably seen it before. This is for a period between 1950 and 2010. It doesn't really matter what the time frame is. They all look about the same. If the consumer panics and gets out of the market at the wrong time and misses the 40 best days, $100,000 invested in 1950 would have grown to $867,000 if they missed the best days. If they stayed invested every day of the market, they got the 40 best days and the 40 worst days. Between 1950 and 2010, that $100,000 would have turned into $6.8 million. But here's the important lesson. I said earlier when I started this, it's more important to not lose money than it is to maximize the return. Look what would happen. It's disproportionate. Look what would happen if this investor missed the 40 worst days. That $100,000 between 1950 and 2010 would have grown to $82.2 million. Folks, this is reality. Avoiding the losses is significantly more important to the bottom line than capturing the best gains. I mean, it's an asymmetrical relationship. I mean, here's a different way of illustrating the same thing that I just showed you on a previous slide. It's dramatic. It's 12 times what the consequence of getting the best days are. Folks, this is a powerful, powerful message to get across to your clients and prospects if you are a safe money advocate, like I know many of you are. It's more important not to lose money than it is to maximize the returns. And I'm not the only one saying that. There are a lot of very, very smart people out there that I listen to that talk about the importance of not losing money. Here's a gentleman I'm a big fan of. I know him personally. I've met him several times at conferences, shared a podium with him a couple of times. Zev Bodhi. Zev Bodhi is a professor at the Boston University School of Management. And he says, you can't handle the truth about stocks. He says, conventional financial planning has it all wrong. If you need the high return of stocks to reach your goals, he says, then you can't afford to invest in them. And folks, the biggest chunks of money in this country are, of course, in accounts being saved for retirement. And here's what Professor Bodhi says about retirement money. He says, retirement money belongs in a truly safe asset whose value won't go down. Again, the importance of not losing money. But that's not the message we hear from all those radio shows and all of those financial talking heads on television. They say, stay the course, stay the course. The market always comes back. But if you crunch the numbers, you get a slightly different picture. Let's go back to the great stock market crash. Between 1929 and 1932, stocks lost roughly 85% of their value. National tragedy. But if you were faithful, if you could stay the course, if you were willing to stay invested in the market at all times so that you could capture the best days in the market, then you would have been rewarded. Because in 1933, the market came roaring back with a 54% gain. And it was in all the newspapers. The market is back. It's up 54%. And then it rocketed through the stratosphere. In 1935, it was up another 48%, followed in 1936 by another gain of 34%. See, the message must have been accurate. Stay the course. Stay invested. The market always comes back. But let's look at the consequences of that initial loss. Let's look at what the real numbers say, the numbers that count, the numbers with dollar signs in front of them. An investor with $100,000 in 1929 would have had only about $15,000 in 1932. But the market is about to rebound, right? It's going to come roaring back. In 1933, it would have been up to $23,100. In 1935, after 2 more good years, it would have still been only $34,188. Folks, it is so much harder to rebound from a loss that even though the market roared and soared, the dollar sign results were different. And it's because in 1936, another gain up to $45,000. So they're halfway back to where they were before the market crashed. Here's the reason why a loss can be so devastating to a portfolio. If you take a typical market correction, by definition is a 20% loss, you see a 20% gain won't get you back to where you were. You need a 25% gain just to break even because you have less capital at work. The one I like to illustrate with clients is if you had a 50% loss, and well, you know what? Has that happened? Yes, it has. To recover from a 50% loss, you don't need a 50% return. That won't do it. A 50% return on half the capital invested only gets you to 75% of what your original investment was. You need a 100% return in order to recover and just get back to where you were. Understanding this math and getting the message out is critical because right now over 70 million baby boomers are fast approaching the retirement stage of their life, and they simply cannot afford to take this kind of a hit. You see, there is a time frame, roughly 12 years prior to retirement and 12 years post-retirement, when everything is on the line. The Prudential ran some interesting commercials a few years ago calling it the retirement red zone. I've heard it called a lot of different things. This particular study calls it the fragile risk zone. But it's because of this. In the 10 to 12 to 15 years prior to your retirement, you will be accumulating as much as 50% of your total nest egg. And if it takes a bad setback there, you might never have the opportunity to recover. And by the same token, a hit early in the retirement phase, a major setback early in the retirement phase, can literally destroy the potential income stream from that nest egg. There isn't time to recover. That's the key thing. Yes, the market will come back, but can you afford to take the time to wait for it to come back? You see, if you're in the distribution phase or the decumulation phase of your investment strategy, in other words, if you're taking money out now because you're in retirement and you need the income, it takes even longer. You can see here in the highlighted examples a 20% market correction down at the bottom would take a pre-retirement, when you're in the accumulation phase, a 20% correction. To get it back to square one in 1 year, you'd have to earn 25%. To get back within 2 years, a little more reasonable, 11.8% on an annualized basis. And if you can wait 3 years, you only have to earn 7.7% to get back to equal. But if you're taking an annual withdrawal of 5% and you allow for a 3% increase due to inflation every year, look what happens now in the top chart with a 20% market correction. To get back within the first year, you need a 40.2% return. To get back within 3 years, you need to average 16.5% on an annualized basis. Folks, it's not going to happen. We're not going to see stock market returns like that probably in our lifetime. It's just not going to happen on a consistent basis anymore. And there are numerous experts out there that will tell you that. Now, the problem is we work on this basic assumption that if you take a higher risk, you should get a higher return. And it makes logical sense. Taking more risk should result in higher returns. Taking less risk, well, the equivalent, lower return. This is the model that we've always had in our head. But last year, a study came out that said quite the opposite. It said that less risk offers more reward. In other words, it's the same point I was trying to make at the beginning of this webinar. Not losing money is more important than how much you make. Let's look what this study said. What they found was that in every one of the world's markets, higher volatility, higher swings in stock prices equals lower returns. In other words, less volatility, less risk, higher returns. Now, I lay this all out on the table because it's important for us to understand what Robert Haugen was saying here. He was saying that controlling volatility and minimizing risk is the way to maximize return. So let's put it in context, because that is exactly the strategy that the momentum builder market-linked CD from Goldman Sachs uses. Exactly that. Now, for those of you who aren't familiar with this product, shame on you. You haven't been on my webinars because I've talked about this particular product a lot. And judging by the money that's coming in, you guys like it too, because this is by far and away the favorite for the last couple of months. And I believe personally that it should be. It should be for a lot of different reasons. But let's look at it in the context of minimizing risk, not accepting losses, and controlling volatility. As you know, most of you, this product is linked to an index that covers 7 different asset classes with 14 different ETFs and a money market on top of that. This is done to spread risk through true asset allocation. It's a defensive position because we know that at some time or another, some of these assets are going to be down. But conversely, because of the inverse relationships in these different asset classes, you're always going to have some asset classes that are up. You're always going to have some that are down, some that are up. But the purpose of this is to minimize risk. The next step they take addresses exactly the issue that Haugen study revealed, and that is controlling volatility is one of the keys to maximizing returns over the long haul. I have explained in a couple of earlier webinars that the process that Goldman Sachs goes through to rebalance every month is very, very critical to the long-term returns. They rebalance each and every month, and they run a computer simulation testing all the possible portfolio combinations of those 14 different ETFs. They look at every single possible combination. And then they eliminate those that show a volatility rating in excess of 5%. That eliminates a good portion of the potential combinations. Then they choose the most efficient, meaning the highest returning portfolio within that 5% volatility rating. A perfect balance of risk and reward. What does that look like in practice? Well, here is the Goldman Sachs Momentum Builder Index over the past year. And you can see there are virtually no major swings up or down. We have a rebound here in the month of August. That's important to note because when I show you the next page, you're going to see numbers only through July. It's important to note on this chart, you did have a major rebound in the month of August. Folks, this is slow and steady, non-volatile growth. This is exactly what the doctor ordered: reducing risk, avoiding volatility, and diversifying across different asset classes. Here's the most recent detailed historical performance. And I've shown this slide or its predecessors a number of times. Going back to 2003. And we can do this with this product. We can back test because it is a mathematically based application using modern portfolio theory and momentum theory. So there's a magic black box that does all the math. No money manager flying by the seat of their pants. And so we can back test this product and see how its performance would have been in prior years. And you can see that the big thing here, look at 2007, 2008, 2009 when the stock market tanked. We've got one negative year in the past 10, and that was a minus 1.36%. Year to date, you'll also note we're already up 3.94%. Folks, that's not bad for an FDIC-insured, principal-protected, and guaranteed market-linked certificate of deposit. This is a product that addresses all the issues that I've talked about in this webinar about reducing risk, reducing volatility, diversifying over asset classes for defensive reasons, and it flat out works. This chart, many of you have seen before. The red line is the index. The other lines represent different asset classes. And you can see the reduced volatility, slow and steady, is an effective strategy. So how do you get out there to tell the story? Well, I sent out an email earlier this week on the Entree marketing system, and I know I've talked to many of you about it, and many of you are already utilizing the system. I'm not going to take time today on today's webinar to talk about it, but it offers a report entitled The Enlightened Saver's Guide to Higher CD Returns, and it's an opportunity for you to approach lots of individuals on a very, very favorable manner by offering them some very valuable information. It's also available with a consumer video that can be sent out to your client base, a short 2-minute video on the report itself and why it would be of value to the consumer. So there's a lot of good stuff there. They normally sell, this comes from a third-party vendor, of course, not from Alternative Design. They do charge $250 for it, but if you order it through me, I can get it for half price. I can get it for $125. So if you have any interest in the system, learning more about it, I'm just touching on it today, please feel free to give me a call on my direct line at 858-240-2059. That's 858-240-2059, Tim Harding, or of course you can send me an email at tim.harding@adisusa.net, and I'll be happy to discuss the system with you and see if it fits into your practice at all. All the materials that I referred to today are in the materials section of your control panel. You can download them. I have the Hagen study in there on risk and reward, which you can download and take a look at. And also, if you have an interest or you've already heard about the Entree marketing system and you want to just go ahead and order it, there is an order form in the materials section as well that you can download and then fax in to me, and I'll make sure the order gets placed. The August cutoff dates, a reminder once again, Friday, August the 22nd for the Bank of the West Income Advantage commodity product, and then everything else, 10 a.m. Pacific time, 1 p.m. Eastern time on Monday, August the 25th. So that'll be the final closing date. So you've got you've got a couple of days here to get those last-minute cases in for the month of August, and if we can help in any way, if you've got a pending case, please be sure and give your business consultant a call. We'll be happy to move mountains if we can to make sure that you get paid on cases for the month of August. So with that, I will stop my banter and go ahead and take any questions that you might have at this point. If you do have a question, please feel free to just type it into the chat box, and I will respond to as many as I can get to, and be happy to answer anything that is on your mind. So let's take a look here. Yeah, Ted also points out here, it's an observation, don't forget how many stocks went out of business as well. Yeah, absolutely. A lot of mutual funds. Tank, I talked about that. There's a very nice study out there from S&P on mutual funds that I talked about a few weeks ago, talking about how the top mutual fund performers are seldom the top performers in the next year, and how difficult it is for money managers to consistently beat even a benchmark like the S&P 500. Scott asks, are copies of these slides available? They would be great to show to clients. Scott, as a general rule, I don't share the slides very often because I frequently use images that may be copyright protected, and although I can use them in an educational setting, using them in the public might be an issue. Having said that, many of these slides I did create myself, and I'm more than happy to share those with you if you think that they would be useful. Send me a quick email at tim.harding@adisusa.net. If you have specific ones that you want, let me know, and I'll do my best to get you what I can get you. Dick asked the same thing, and he says, can attendees get some of your slides as they're not MLCD specific? And yeah, Dick, that is the case. The ones that are general and I don't feel have a copyright issue with them, I would be more than happy to share those. Bill asks, if we already have the entree system, how do we get the video? Yeah, I know a number of you purchased the entree system over the past year prior to the production of that video. Send me an email, and I will make sure it's forwarded to you at no additional cost. So Bill, just send me a quick email, and I'll make sure we get it off to you. The deal on that was they asked me if I would produce it, and I said yes, as long as there's no cost associated with it to my agents, because at ADIS we want you to sell the CDs. So I was happy to do it because I thought it was a good idea, but because of I didn't want to charge you anything for it. So yeah, Bill, we'll be able to pass it on to you. Jeff, oh, thank you, Jeff. Valuable suggestion. He says, point out the camera icon top right of the screen, and you can save an image to your desktop. Okay, so look on your control panel. On the top right-hand corner, according to Jeff, there should be a camera icon, which would allow you to capture my slides without my even knowing it. So thank you for that tip, Jeff. I'm going to investigate that a little bit and see if we can't publicize that a little bit more. Bill says, got to the webinar late. Is it recorded? The answer is yes. I record every Wednesday webinar live. They're usually posted on our website behind the agent portal by Thursday morning. Occasionally there are technical difficulties and the recording is flawed or corrupted, but our intent is to post a recorded version every time. So it should be up here by this time tomorrow. Okay, looks like we're pretty close to the end here. Let's see. Bill says you can, another tip, Bill says you can also do a print screen to save Word. And Scott says the only problem with the camera suggestion is that it's difficult to print or transfer to Word or other program when you print it out. Okay, great. Now we're in techie world. Bottom line is I will share those slides with you that I can. And if there's technology that makes it easier for you to grab it, grab it. And if not, I'm still open to sharing what I can. So looks like that's it for the questions. We're pretty much right on time. So once again, thank you for joining us this week. We'll be back next week, same time, same place, 11:35 Pacific time. Until then, have a great week.